Hello, everyone. Welcome to the closing playbook for Wednesday, Hump Day, October 8th. I hope everybody had a pretty good day in the market and in life. We're looking pretty green on the market today. Hopefully, that's how you played most things. We will find out. We don't have closing playbook theme song yet. Graham was actually working on that with the same person who did our opening playbook theme song, but we ran out of credits with the system we were using, and we got like 80% of a song, and then it just cut off. So we don't quite have it yet. Hey, Nathan.
I keep thinking you're going to sing a theme song for us and live up, but
I mean, if we
so
want to
far
lose
this
everybody, that's a good
that's
tactic.
disappointing.
That's a good tactic. My mother was a professional singer, and I've only gotten paid to stop singing. So you don't want to hear that. Yeah.
Fair enough. Fair enough. Well, I can't say that I would do much better. So I guess we're stuck until AI comes and saves the day. All right. Well, how's everyone doing? Got the big buy the dip day that we kind of expected. Big move in a couple of different areas. Some people mentioned overnight options should be posting right now.
Yep,
We had that situation again, guys, where because of the volatility right now, we're just not getting really great prices on those. So we are having to be a little more patient, but should be in there now. Take advantage of that.
Tis is.
I'm always kind of double tasking as we get on to closing playbook with that trade. So a couple people said they went 4 for 4 on overnight options yesterday. They took all 4 of the symbols and went bang, 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 bang. So that's a heck of a buy the dip.
Indeed. Do you feel like any of them are so closely related that, if people don't want to over leverage, they should only take one of two or one of three? Or how do you feel about that?
Yeah, for sure. I mean, if you're going to take SPY, Q, and IWM, you probably want to do like 1/3, 1/3, 1/3 sizing versus treat them as if they're 3 different separate trades with separate outcomes. They're going to be, they're going to be like 90% consistent on performance. GLD is the nice one that can kind of go with the flow or be a hedge in different environments. So that's been a good one. I think kind of across the board. I know a lot of people use that back to back. So they've been on a hot streak with GLD. Let's speaking of buy the dip, let's just take a quick look at where we're at right now on those trades. So when we opened up this morning, even the market was already popping, a lot of those were kind of lagging behind. I was a little disappointed, but we've caught up quite a bit so far. So we've got Hood that's up nicely, IWM that's up nicely, IBIT that's up nicely, Oklo not doing a whole lot, and then Tesla is basically break even, right at 0%. Now, the crazy thing about Tesla is that we're up 1.2% on the day, and yet that trade is break even. So I don't know if we just got horrible pricing yesterday. If we did, my apologies, because that's just weird. At 445 is our point. So we're about, we need another 1%, another 2%. In Tesla, we've got 1.2% of the way there. I mean, that was probably our most aggressive one, but still, with Tesla up 1.2% in the first day, you would think this guy would be up a little bit, but not so much. So that one's a little underperforming, but overall, I think we're in pretty good shape on those. If you guys want to take some profits, on the ones that are up, and then you have kind of a little bit of a hedge situation there where if Tesla wins, great. If not, you've still kind of been, collected your profit and got net ahead regardless. By the way, folks, look at AMD. Dave, I was complaining yesterday, or I guess that was 2 days ago, that I didn't close everything before the open because I closed about half my shares at the pre-market, right in this 225 range. Well, my complaints did not last long because we were at 234 on AMD, up over 10% today again. What an incredible move we're seeing in AMD. Now, the crazy thing about AMD And this is, by the way, what I always tell you guys: don't get too cute saying something's overbought and time to short it the other way. The crazy thing about AMD is that we're just barely over the highs here, folks. We are not, in terms of true extensions relative to all-time highs, which I think are the most important ones to reference. I think all-time high extension is the most important thing to look at. We're not that far past all-time highs. I mean, take a look at NVIDIA. Okay, here's the same high from NVIDIA at 152. We're 20% above that. Palantir. Look at that. Same high back from Palantir at 125. We went to 190. What's that? Like 40% above it. I mean, and you could go on and on. Oracle. You could even go to the ANET one that we waited forever on, and then it popped and is way ahead. Obviously, Google just drastically ahead. So a lot of these stocks, big, heavy names, obviously AVGO is another one. I mean, just look at AVGO. People said once we cracked the 250 high over here, hey, it's overextended. We're back at 250, overextended. Not so much. It is now at $370. Well, a little bit lower now, but was at $370. So I actually think AMD has plenty of room. Now, will it probably choke on itself a little bit here between now and $300 a share? Probably yes. But I still think that not getting too pessimistic, if for lack of a better word, that just because it shot up, it needs to head back down is something to be careful with here on AMD.
So let me just jump in here with something that a couple of people are talking about, the O&O tool showing no qualifying trade. So listen to what Nathan was saying when he first came on about that, which is that things are, in a situation right now where it's hard to find qualifying trades because of where certain things are and the pricing and the valuation of things. So that tool updates in real time. If you wait a couple minutes and refresh it, it might give you trades, and then you do it again a couple minutes later and refresh it, and those trades are gone because the pricing has moved and it's not within limits. So that's why it took a little time for him to get the trade out today. And that's why, if you don't see trades in there, wait a few minutes, refresh it. But then if you do get a trade, you need to act on it fairly quickly because things will change, and you need to make sure that you get it for the price that the tool tells you and that you're not too late to get it and you need to refresh it again.
Yeah, that's exactly right. SPY is right in that kind of in between where a couple pennies on both the mid price of the spread and the underlying price of the SPY itself are going to flip back and forth between no valid trade and a valid trade. Normally, it's not like that. We actually haven't seen that at all up until just a couple times the last few months where, the positive expectancy in SPY is so high, volatility is so low that now you get this mix of just not a lot of good qualifying trades. But that's where we're at right now, which means you literally do have windows of time where not a single trade in the thousands of option combinations actually fit the criteria. And the criteria are not that strict, guys. I mean, if you guys are in overnight options, you know what our criteria are. They're not that strict, but the implied pricing of the SPY is very, very high, whereas the implied volatility is actually very low. That combination makes for not a lot of spreads. Like taking a look at our sectors here, folks, we talked about technology ripping. I mean, this was, at 10 o'clock right here, where it was up about 0.8% on the day. It's now up 1.4% on the day. Industrials, we talked about we're flipping. You guys remember at 10 a.m., I was saying, industrials are flipping back to the positive side here. One of the sectors we thought, has still more potential, more gas in the tank. Well, that's now up almost a full percent. Healthcare, kind of been flat. Energy, a little bit of a recovery, whereas staples, communications, financials being the laggards. So I think this is something that we're going to have to keep an eye on here in this, if we get this squeeze up environment. Here's kind of, I guess, the note to take away. If we get an aggressive squeeze to the upside over the next 3 months, 6 months, 9 months, which I think there's a very good chance of 3 months, a pretty good chance of 6 months, and a decent chance of 9 months of all of those being aggressively bullish. Here's the note that I want you guys to take. Remind me that I said this. Hold my feet to the fire on this. but also make sure you're not on the negative end of this. In those environments, what you typically see, whether it's COVID rebound, or tech bubble, or pick your squeeze, what you will often see is a massive deviation between the top performers and the rest of the market. Okay. It doesn't mean the rest of the market won't go up. It will, because the outperformers pull it up. But go back to like the 1997, 1999 run. I think, correct me if someone in the chat can look it up in real time. I think it was like the SPY was up 28% over 2 years, and the NASDAQ was up like 150%. So even on big on indexes, you're still seeing, just because one's weighted more heavily, those outperformers driving things. And so all of that to say, I think the sectors running away are going to be very, very critical for us to watch if we get this kind of melt-up environment, where you might be trading, some good basic materials and some good discretionary stocks, some good communication stocks, and by good, they might go up 10% over the course of 6 months, which is a great return. Meanwhile, the top technology stocks are up another 100% in the same time frame. And the reason I think that's important is because you can't go back and get that. 6 months from now, if we say, oh man, ANET literally is up another $100 a share, AMD is at $400 a share, Hood doubled again, whatever it might be, you can't go back and create that. It might be another decade before you get that kind of performance. So I think it's going to be really important to watch these sectors, see what's leading, and try to take full advantage of the ones that have the best opportunities. All right, let me flip back, because there are a couple that I want to keep an eye on here. Metals and mining. So I think someone mentioned there.
Yeah.
Not typically one of the the main what we would consider like S&P sectors, but certainly gold, silver have been an absolute rocket. I gave you guys GDX 3 weeks ago. Anyone trade GDX over the last 3 weeks? I said we're still in that moment where there's a lot of hype and excitement where GDX should outperform gold, and then it will start to underperform gold. We're up another 2% on GDX. So in the last, since we talked about that in maybe early September, GDX was in the low 60s, mid 60s, up to 78. That's what? That's 20% on GDX. Unbelievable potential here. This is the kind of stuff I'm talking about. Exactly like GDX. XME is a good example. I don't typically put that in my sectors, but yeah, absolutely ripping and running right now. So what are the opportunities that could potentially squeeze? Well, let me give you a couple to consider, and then we'll do a trade on one. So the first one I'm going to talk about, actually, I'm going to talk about a couple that are more in the catch-up variety. Okay, so let me go back to my regular chart here. So the first one is Meta. I've been calling out Meta quite a bit. This is in the catch-up variety. I think Meta is actually one of the best positioned Mag 7 stocks, and has been underperforming now for several months. Seems to have wanted to build a base here above $700. That $700, has acted as a support level, as you see back here and here, kind of stopping right in that range. Here. So $700 seems to be a decent psychological support level, and we seem to be trying to build a base here. Meta is a stock that, even though it's $1 trillion market cap, can cover this ground very, very quickly. So Meta is one that I like. We actually have a little buy the dip trade on Meta right now. And I think this falls in that category of, if we do get super aggressive buying, the melt up environment, Meta, I think, is one that could rally very, very quickly. This is the catch up trade. So let me put that in there in the chat. Meta catch up. Then another one that we've talked about is Novo. This is also in the catch-up variety. Now, this is not one that I expect to be in that crazy category of if the heat gets turned up, that Novo is going to go crazy, but it has a little bit of a different catalyst for it that I think is worth noting. Number one, I think in general, it's a good catch-up opportunity. If you go to the weekly chart and we go way back yonder.
Yonder, I know where that is.
Go way back. You can see, wow, that correction is just unbelievable. By the way, I do have to pat myself on the back a little bit here by saying we talked about Novo and LLY, specifically Novo, being a short opportunity when it was in the 140s way back when. If you guys have followed my Telegram all the way back to when it was in the 140s, I think I listed it as my favorite short opportunity, although I will admit I did not see it going down to $50 a share when I said that I thought that it was, potentially on the short board, but it has absolutely been massacred down. So if you look at Novo, guys, this is a stock that has not historically had major pullbacks. Really, the one we see is all the way back here 10 years ago, 2014, 2015, maybe 2016, somewhere in that range. Since then, it's been one of the best stocks on the planet up until this recent collapse. Now, the reason that it's been one of the best stocks on the planet is fundamental to how healthcare is running. And so if you believe RFK and company have broken that fundamental advantage, well, then maybe you'll just never trade Novo again. I'm not quite that far. I do think they have some limitations and some challenges, but I think in a healthy environment, all of these profitable companies will start to catch up. There's so much catch-up room here. And I think that Novo, even in a different, quote unquote regime within, the health administration, one breakthrough drug, this stock's at all-time highs again. And the potential there is just so massive that I think it makes the list. So NVO is the other catch-up stock that I want to mention. Let me pop that in the chat as well. So that's one to put on your list. I actually do have an NVO trade targeting $100 a share by mid next year. It's like a 12-to-1 risk reward or something. So you could look at that. I'm not going to give that one out today because I have my eye on another one that we want to look at. But, you could trade NVO as a kind of a 10-to-1, 12-to-1 trade by targeting just half of this recovery over the next year. And then there's a couple that are not catch-up, like Hood. Hood is clearly not a catch-up trade. This is just a pure, full-on momentum squeeze. Can it do what it's done for the last year, or last 4 months, let's say? Can it do it for 2 more months? This is not like, hey, it's going to catch up if things get healthy. This is like, hey, can we keep the blitz on? So let me add that one here. That's Hood, just a pure momentum squeeze. Now, when I say squeeze, I don't actually mean short squeeze. I mean buying squeeze. I mean pressure, squeezing it higher and higher and higher because there's so much attraction. And the thing with Hood is I think the fundamentals will continue to be unbelievable. I think that, they're going to continue to just pour on good fundamentals on top. Oklo is one we always talk about. You can throw that. Similar on the list. Industrials heating up. I think Oklo has been a monster, and I wouldn't be surprised if we continue to get squeeze on Oklo. So you can throw that one on the list. Iron is the one that just, oh my goodness, look at that chart, guys. Oh my goodness, look at that chart. We talked about iron when it was $15 a share. It is now $61 a share. Pretty incredible move there in iron. So I can't even put iron on the list. It's just so ridiculous at this point. I mean, we thought CLSK, look at CLSK. We thought CLSK was making a rip, and it has. I mean, unbelievable, up to $19. But compare that to iron. Just iron. What a unbelievable opportunity there. So a lot of these, have already made a move. But I think the thing to remember about these kind of opportunities or these kind of market conditions is that we don't want to get, too cute and say like, oh, it's oversold. It can't go any further. All right. So let me give you probably my favorite one right now, which is pure momentum as well. That's AJQ. AGQ is just a leveraged silver ETF. That's all it is. It is on an absolute ridiculous run from 50 to 82. Guys, that's like a 60% run on AGQ. So the question is, well, can it keep doing it? Well, we have had some other runs on AGQ that are even more historic. This one went from $12 to $71 That's like a 600% return from March to July. That's 4 months. So we have seen AGQ do this before. If it mirrored that 50, this thing would be at like $200 a share or something within, the next 2 months. Now, do I think AGQ is going to be at $200 a share in 2 months? Probably not. But this is just kind of one that you can trade as a pure momentum. You'll risk a couple bucks. If you lose, which you probably will, you take the hit. But if we do get just the next layer of AGQ, of silver ripping an AGQ behind it, we could stack up a pretty monster winner. So let's go take a look at AGQ. We've got 10 minutes here. Okay, perfect. This is one I'm going to give it this December 19th. So that's 72 days away, just a little over 2 months. And basically what we're going to do is we're going to say, okay, it's already gone from 50 to 80. Can it do another move that's half as big as that? Can we go another $15? That's $30. Can we go another $15 higher on AGQ over the next 2 months of what we've seen in the last couple of months? And if it does that, the risk reward is just going to be pretty wild. So let me show you what it would be. It would be about a 400% ROI if we get half the move over the next 2 months into $100 a share. It's at 82. I guess it's $18. It's a little more than half that move, but on a percentage basis, it's actually more like a quarter of that move, by the way. We would make about a 400% return on AGQ. Again, that's the December 19th. So we're giving it just a little over 2 months. So let me give you this one. By the December 19 AGQ $95 call. And again, this is obviously very speculative. We're looking for what's that going to end up being? A 25% underlying move in 2 months. Yeah, that's a pretty speculative trade. But I think these are the kind of picks where with defined risk, I like right now. I like leaning into the market that we're in and just saying, hey, I can take advantage of a really outsized return with defined limited risk versus putting my whole boat, at the top of, all-time highs and being in position where if I'm wrong, I'm going to get hammered. That is debit. And this is another one I'd be pretty patient with, put a debit in of $1. If it is not filled in the next couple minutes before market closed, just try it again tomorrow. Probably not going to run away from you. In fact, you might get a little dip tomorrow, and then you will be, in potential to get in for 95 cents or whatever the case may be. So just going to go ahead and throw on 10 of these, and I'm going to go for $1 and let that sit in there. If I get filled, great. If not, I'll crawl it up a penny or two. But that is the trade on AGQ. So we've got AMD as kind of a pure momentum carry on trade. I don't know if I can justify saying it today with it being up literally 11% on the day, but I think that's one that could go up to $400 a share. We've got Oklo. We've got Meta as a catch-up. We've got Hood as a pure squeeze trade. We've got NVO as a long-term catch-up. That's the trade that I have that $100 debit spread on going out to middle of next year. Okay. Oh, and we got filled for $1. There you go. Any questions about those couple of trades, how you would map them out and plan them? All of those I would do as debit spreads because of what I was just saying. So for me, one of the big benefits of doing a debit spread is that we can be very, very aggressive in terms of expectation. We can trade something 20% out of the money and we can give it time, but we can do that with defined risk on the lower end of the spectrum versus, buying some calls. The bid ask is a little bit wide, but I just got filled for $1 below the mid price. So I don't think you should be worried too much about that. I don't really care about bid ask in most cases because I typically know what I want to pay. And if I get filled, great. And if not, no worries. In this case, I actually got filled below that mid price. So the spread there shouldn't be an issue for that one in particular.
Couple quick PSAs, or you still want to move on this?
I was just waiting to see if anyone had any questions about that. I just kind of threw a lot at the different catch-up trades in the structure, but go ahead if you have anything.
No, I mean, I was just going to move on to the next thing before you got into anything deep. But if anybody has any questions on this, let's get those first. So there's only one actual trade rec. It's in the chat. It's in the announcements below. So there was only one trade so far, and then a few tickers to watch for possible catch-ups or momentum squeezes. Those are in the announcements as well. So for the people that come in a little bit late, miss the very beginning, and come in and say, "Hey, I'm late. Are there any trades?" The trades are always going to be posted in the announcements below. So just personal favor to me, you'll save me a lot of repetition of telling you, no, we haven't traded yet. If you come in late, just look below in the announcements. You'll see the trades there if you miss them in the chat or you come in late. Also, in case you weren't here for opening playbook, Jeffrey Turnmeyer, who many of you know, another trader in our network here, in our company, is coming out with a brand new automated alert system. And he's holding a special event to launch that on, I guess, Sunday is the 12th,
Yep.
I think.
Yep.
And that link for that is down below in the announcements as well. 1 p.m. Eastern time on October 12th, but you have to sign up for it in order to get the link for it. So check that out in the announcements. I think that's it.
Thank you for that. And the Jeffrey thing's pretty cool. So check that out on Sunday. So I do have a couple of these other trades. So people are asking, I think, how do you manage these kind of trades? So I have a couple of these right now. I have this NVO trade, which goes out to September of 2026. I have the $9,500 call there. Obviously, that's a year out, so I'm not worried about managing this trade. I have this TLT trade, which goes all the way out to 2027. I have this Palantir trade, which goes all the way out to December of this year, which I put on a while ago. And then I have this Tesla trade, which you guys should all know about because I shared this in the roundtable. What was that? May or so, which is going out until June of next year for all-time high. So these are how I handle these trades. I put on a spread with very defined risk. I set it up. If I'm going for a big target, 3 months out, 6 months out, 18 months out, just depending on how much time I want to give it to make that move. And then I manage it with time. So I manage it where if it goes way ahead of schedule, like our CLSK trade, which I'm probably going to close because it's just way ahead of schedule, then I'll close it more early in the process. If it's kind of grinding along at the pace that I would expect, then I'll hold it and I'll wait. So these are the examples of those kind of trades. If you guys want to do this kind of trading, I think it's a great way to kind of have something in your portfolio that's longer term, outsized gain potential. In fact, Graham and I were thinking about building a long-term double up portfolio. I don't know if you guys would be interested in that, but just kind of building a free double up portfolio where every week we add one trade to the long-term double up portfolio. They're always going to be, 3 months out or 6 months out or 9 months out, but you're kind of building this longer-term portfolio of all these trades that have bigger gain potentials. And as you start to hit them, 3 months later, 6 months later, 9 months later, you're adding kind of those capital infusions into your account that you're not really managing on a regular basis. So that's something we've been thinking about doing. I told Graham the crazy thing is, and Dave, maybe I need a legal disclaimer on here. You can be my legal editor after this. But I told Graham I have been doing these trades for a couple of years where I'll put on a really aggressive trade, 20% out of the money, 30% out of the money, but I'm giving it 6 months, 9 months, 12 months out to do it. Dave, I don't think I've lost one of those trades yet. Now, there's only a handful. I've only probably taken maybe 7 or 8 of them. But I'm talking about trades that have targets of 200% or 300%. And yet, I don't think I've lost one yet, where typically you would expect a 30% win rate. But it's because, and that doesn't mean I'm always going to win them, to be clear, but it's because if you are in a situation where the market itself is in a good position, like some of those April trades we took, and you just simply say, I'm going to err on the side of more time, your opportunity to actually hit that is extremely high. And when you do it in the spread, you're just kind of hacking the market there with time. I mean, there's a reason, guys, that if I took that Tesla call option 1 month now compared to 12 months now, it would cost me 10 times as much money because that time is so valuable. And yet with the debit spread, you pay almost nothing for that extra time. So it's such a big advantage in that way. So anyway, Dave can be my legal disclaimer and tell him.
I'll just add to that past performance is not necessarily indicative of future results, and 8 trades is not enough of a test to validate a strategy. Thank you, and have a good
Dave.
day.
See, there you go. That's why Dave's on the call right there to tell you. It's not a guarantee, but it is. I think it is a great way to trade, or not to trade necessarily, but to have some of those kind of bigger capital injection opportunities in your account. I mean, this is just my small account, guys. This is my account that just crossed 50K, and you can see the Tesla position alone is up $5,100 in open P&L. So I mean, think about that. That's a big chunk of the P&L of this entire account, just made up from one trade. And so those are the kind of capital injections I think that are nice to layer on top. Now, if you guys know jump trades, which will actually, speaking of jump trades, I'll play the jump trades presentation, or we'll play it directly in here, because I did it 2 days ago in a separate session. We closed out a special at midnight, but it wasn't during opening and closing playbook. So I had hundreds of people who never even got to see it. And they said, oh, you closed the deal too quickly. So we actually opened that deal up one more time. We'll run it again to midnight tonight if you guys missed the jump trades thing, so that no one can complain that I closed it out too early and no one saw an opening and closing playbook. But jump trades is basically this idea on a shorter time frame, getting those bigger capital injections flowing into your account where you can hit those 200% winners, 250% winners there. But I like to also blend it out into a longer time frame. So that's another thing that I'm planning on doing in jump trades, is just giving you a couple of these longer term trades as a bonus in jump trades, where yes, you have your trades that you're hoping to hit 200% in a week or in 10 days, but you're gonna have a 55% win rate, 60% win rate when you're doing well, because the winners are more significant. But you might have a couple of these that, because you're giving it so much more time, you're getting the benefit of that win rate going up, and having those hit your account on a less frequent basis, but a more substantial basis. So that's the idea there. If you guys don't know how jump trades works, we'll play that presentation here in a moment. But that's kind of the idea of these long-term trades. They're basically a way to give yourself more time with that same idea.
Would you say that on those further out ones, the pricing of the options can really change a lot from like 1 week to the next, where like this week it may make no sense to get in it because of the price, and then next week it can be great? I mean, I seem to see that a little bit.
Yeah, well, especially if you're trading something like AGQ that's not going to have a ton of liquidity, you can get some goofiness there. The good news with trading spreads is that you should have some framework for the risk reward that you want, kind of regardless of what the market actually says it's priced at, right? So I kind of know, hey, if AGQ can move up another 15 to 20%, that's a big time out of the money move, but it's a leverage ETF. I probably need to make 4 or 5 times my money there. Then if you go look at the asset at the chain, and it's like, hey, you can make 100% return, you immediately know that's not worth my time. I need to make 4 or 5, 6. At the same token, if you go in there and it's priced to a 10x, you immediately say, oh, that's really juicy for the relative expectancy of this trade. I had that one on NVO. I actually thought the NVO pricing was too good for a full year. I thought it seemed more to me like 6-month pricing for the year pricing. So sometimes you get those on, I don't think a lot of people are trading September 2026 NVO options, right? So the liquidity is low, it's thin. Sometimes that works against you. Sometimes it works in your favor. And kind of knowing what you're looking for is actually a big advantage there, because you kind of know what a good deal, kind of like when we talk about earnings, right? You see us talk about earnings, and sometimes we're like, hey, that's kind of a good price for earnings within the expected move. And other times we're like, oh, it's a horrible price. I'm not going to pay that for that trade. Same kind of thing here. Kind of knowing also, like, what you expect.
When you're doing the spreads, the goofiness kind of cancels itself out a little bit, because it's the same ticker. So if you're doing like a profit pair, that probably wouldn't be true. But if you're doing a regular spread, then it's like you're buying and selling the same goofiness.
Yeah, and I think one of the most underdeveloped things with spreads, I mean, hopefully we have given you guys the full education on spreads, why they're so advantageous, how to use them in different ways. But one of the big unsung heroes is simply turning them into longer term trades. I mean, let's just look at Tesla real quick. Let's just look at Tesla.
While you're looking that up, if there's anybody here who has not taken the debit spread training in one of our members areas, can you say so in the chat? We want to make sure you know how to get that if you have never seen it.
Take a look at Tesla, where if you wanted to trade the 442.50 spread, in other words, you want Tesla to go up $7. And you want that to happen in the next 16 days. Okay, so let's just do 16 days, $7 move, $1.05 on a 250 spread. Okay, that's the ratio that you're getting there. Now, let's go out all the way to March. So let's see. I don't know if March will have the $2.50 spreads, but we'll see. It doesn't, but that's okay. We can still do a fair comparison. Oh, actually, it only has the $10 spreads. So let me redo it a little bit here, and we'll say 440, 450. All right. 163 days. That is now a $12 move. $420 on $10 spread. Okay. Then let me go back to where we just were on the 16-day chain here. And we'll set up the same one. We'll set up a 440 and a 450. And here it is.
All right, Andy, we try not to be nice to Nathan in the chat. But we'll take your comment. Thank you.
Thank you, Andy. Okay. Does anyone see anything interesting about what I just pulled there? I did the exact same spread there, the 440, 450. So I need a $12 move on Tesla. One is 16 days away, and one is 163 days, 10 times further away. They're like the same price. So now compare that to a $4.50 option, or $450 strike regular option, call option. That's $19. Okay. So now we're going to compare to that. $19 straight call. Remember, same $12 move. Then let's go out to 163 days and find that same $450 call. Whoa. What do we have here? All of a sudden, we've gone from $19 to $65. So guys, we just saw that a spread with the same intention of the trade didn't budge, even though we went 10 times longer out. And yet the exact same call, the same intention of the trade, went from $19 to $65. Do you see why, using the spread to carve out that premium makes such a big difference, even more so the longer you go? So that's, to me, that's kind of one of the unsung heroes that we don't even talk about a lot, is turning those into longer term trades, because the advantage of the time discount you get is actually even more inflated the longer term you go. So just an example there of Tesla, of what that looks like. Pretty wild.
Yeah, it's a great example.
And what we're trying to do with jump trades, which we show here, is not quite on that long of a stage, but same idea, right? The calls to go out of the money and give yourself enough time become really expensive. We flip it around and can get a much smaller move and still make the same, 150, 200, 250% potential that an out of the money call would give, but without paying for all that time and without getting beat over the head as soon as it's not moving aggressively in your favor. And if you guys have never watched the jump trades presentation, there are some insane examples in here. I mean, this is probably my favorite presentation, because it just shows the true power of the options, where you see an example like a perfectly timed trade on Meta, where with a regular option you lose money, and with the trade structure of jump trades you make 250%. The same trade at the same time with the same entry. I mean, it's just remarkable in my opinion when you really understand that. So if you guys missed the midnight special dealio here on jump trades, we'll give you one more day to do that. Sorry, I didn't mean, my intention obviously was not to purposely hide it from opening Playbook and closing Playbook. We just had a lot going on, so I popped up and did it at 1 p.m. In the middle of the day, and some people saw it and some people didn't, and we closed it out. So again, no intention there of like hiding it from you or anything. We brought it back. If you missed out, you can check it out right here. You guys know the drill. Profits and performance, not typical. I'm not going to make any future claims. This is for my live trading over the last year or so. It's about a 60% win rate, kind of like Graham was talking about the profit factor and the ROI. We're going for a lower win rate compared to something defensive, but for much bigger wins. You can see there the average win 166% based on this strategy on real trades. Obviously, can't guarantee specific future results. All that good stuff still applies. Now, it might sound wild to make 200% on a small move in the stock, but hopefully what you'll learn and what Graham just touched on will shake up how you usually think about options and open your eyes to a new way to target these outsized gains each and every week, meaning whatever stock you like, whatever opportunity you like, or if you want to follow me and use my specific ones, you're going to get opportunities each and every week because you don't need some rare, massive move to target 150 or 200%. 190% on Tesla, 233% on MSTR, even a crazy 1,500% on SMCI. Now, let me be clear. What you're going to see today, what I'm going to talk about, these are unusually large returns. These are the biggest trades I go for. The average winner is 166%, way bigger than most of my strategies. But every example you're going to see today are from real money trades placed by me in my own account. They're not hypothetical entries, no curve fitted back tests. If you ask me, that only feels right because the magnitude of jump trades is that we're going for these big wins. So it only seems fair to show you real results that actually happened in real time, not could have, would have, should have. Oh, we could have made 200% if we look back and found NVIDIA. Obviously, that's not fair. We want to talk about real opportunities. So you're going to see all the data, every winner, every loser, so you can decide for yourself, hey, do you want to trade with this more aggressive approach, targeting 100 to 200% this very week? And I firmly believe once you see all the live trade examples, the incredible nearly 3 profit factor, and how 5K in each of these could have been more than a lawyer salary over the last year. Yep, about 200K in the last year. Well, I think you'll fall in love with this structure of going for those big wins, just like I have over the last year. So welcome to Jump Trades. As you guys know, my name is Nate Tucci. You probably recognize me from doing the 10K to 50K challenge or the overnight options guy, which I'm sure most of you recognize me from. Thanks for all my, I saw a whole bunch of people already in the chat. Overnight options, ding, ding, ding. Give me a yes in the chat if you hit your overnight options winner today. We've got so many testimonials from that. It's been a lot of fun over the last couple of months trading overnight options. You can see as they've piled in here. One of these is pretty wild. Someone up 60K year to date on overnight options. But if you follow me, you probably already know my goal isn't to be a talking head on mainstream TV. Not trying to get on Kramer and create my own park or pack or whatever he's making next. That's not what I want to do with my life. You're a lot more likely to catch me hanging out with my family at the beach or a Penn State game than in Wall Street. But today, I want to detail what I truly believe is probably the most important option secret you'll ever learn if you don't know it already. Graham already alluded to it. A shocking way to target 100 to 200%, sometimes even more, even when a stock actually moves less than it's expected to. So if you're taking notes today, please write that down. We're targeting stocks moving less than they're even expected to move. Now, to be clear, I'm not typically a directional swing for the fences type of trader because, as you know, every strategy is going to have winners and losers. And even the best swing for the fences tactics take the most frequent losses, obviously. And if you know me, you know that I don't really like to take those big risks, which is why I've built my career with special option strategies that focus on the highest accuracy, generating weekly cash flow as often as I can from the stock market. Usually my sweet spot is 15 to 25%, or maybe up to 50%, 60% on the more aggressive trades. And it's how I've been able to maintain really great win rates in, pretty much across every strategy that I've ever developed, nearly 70% on automated options, 100% win rate on weekend options, so on and so forth, because stacking up those kinds of high probability gains is where you'll hear a lot of the best feedback from my students. These are, again, most of what I do. Like Ken, $2,500 to $3,000 per trade. Jan, over $5,600 so far. Dennis, 13 trade, 10 wins, around $7,000 in profit. Lynn said, came in not knowing anything about options. Nate's a great teacher. My account is growing, and I can't wait to do more trades. And so, again, that's most of what I do. Those super high win rate, steady stacking up ROIs. But today, we are talking about something very, very different. So please, if you guys love overnight options, you love the income machine, I'm happy for you. But put aside some of the preconceived notions about those, because today we're talking about something that I do less often, very different, a more directional approach to the markets. And over the last few years, I've been dialing in this strategy with the goal that gives me the safety of the high accuracy income structure, while at the same time providing incredible upside on short-term moves. And again, the average winner sitting at about 166% for my live trades so far. Now, that combination of win rate and upside in my real money testing has shown the power to scale even a small account quicker than anything else I've seen before, because we're going for all that upside. So take CCJ, for example, between mid-March to the beginning of May, stock ripped, just like it has recently, by the way, 33% in a few weeks. And so most people would have considered that stock overbought. They weren't exactly wrong that CCJ was probably overbought, but I thought it had room to go a little bit higher. So on May 16th, I put up my brokerage, took about 60 seconds, set up a jump trade. Anyone following along could have traded that one for 29 cents a contract. That's how cheap it was. And sure enough, 4 days later, that trade ripped and we closed out for a 200% return on a relatively small move in CCJ. So a $500 stake would have turned into $1,000 in profit. 5K, you would have made $10,000 in about 4 days. And with jump trades, we get to do that over and over and over again. For example, Coinbase, again, ripped, more than doubled over a 7-week period. All the conventional wisdom would have said, hey, stay on the sidelines, wait for the next opportunity. The stock was trading at the upper range of the Bollinger Bands, finally kind of bouncing back down. RSI was overcooked. MACD was peaking out. Everything would have told you, hey, a pullback in coin is coming. However, I like momentum. I was all systems go. We had a jump trade on coin. Again, this one would have been about 65 cents to enter, so under $1 to enter Coinbase, which is very cheap for an expensive stock. And only 3 days later, Coinbase ripped 284% on Coinbase in 3 days, guys. Now, again, that's not every trade, but it shows you the potential of flipping the structure on its head. 284% in 3 days. So if you put $500 into each of those trades, you would have been sitting at $2,420 about a week later. $2,500 into each, you're looking at $12,100 over the course of about a week worth of trades. Again, those are real trades, not back tested. Now, I can't think of a harder time to get ahead. I mean, I've beat this dead horse with you guys over and over and over again. I'm sorry you have to listen to me say it, but it's just worth repeating that hardest working folks get hit by inflation. Why? Because the upper class, the people who have billions in assets, they benefit from inflation. All their assets gain value. So the wealthiest people do great in inflationary periods. And the people at the bottom of the barrel, well, they get government subsidies and things that help them. It's the people in the middle that get hit the hardest, which is why we've seen savings account hit the lowest level since 2008. All kinds of things just get worse. Credit card debt hitting the highest levels. And even if you got a raise, it probably doesn't make the difference on a grocery bill, especially if you're like me and you have 7 kids to buy groceries for. Trust me, inflation is real and it's sticky. But with jump trades, we're going for those outsized returns. So folks could have ended up with $12,100 in 2 trades on a $2,500 stake. So hopefully you guys are seeing what I mean. This is not the income machine. This is not overnight options. This is not 17%, 18%. This is not weekend options. We're going for those outsized needle-moving returns over the course of just a couple of trades. And again, every example is based on real trades that I took in real time from the same method that we've averaged 166% average gain on the winners. The same method, I'll be using target another 200% gain this very week. And if you're tuning in right now, I'm hoping you'll join me on that trade. Now, I want to remind you, I don't have a magic 8-ball. I can't predict the future. Just like with any strategy, there's going to be winners and losers. Obviously, I'm not betting the house on any one trade, but that's part of the benefit of trading with risk-defined trades. You don't have to. Now, we only trade jump trades with a very specific set of signals on very specific stocks. And by applying the special type of trade that meet that criteria, we're able to flip the biggest advantage that Wall Street has, which is what Graham kind of alluded to with those overpriced options, giving us a chance to target triple-digit moves on regular stocks, which is why we've been able to have that 2.6 profit factor, meaning for every dollar lost, we're making back about 260 on average. And if you look at what Graham was talking about, the cager, it's even better because this is going for those outsized returns. Every $5,000 so far has returned about $13,000 in return. And again, this is on live issue trades, guys. We're not talking about a curve fitted or a theoretical trade case here. Now, if you haven't been able to trade with odds nearly that good when going for those big wins, the first thing I would say is don't blame yourself. Okay. There is a major, major problem that's been unfolding in the stock market over the last few years, actually going back about a decade, which has essentially made regular options almost impossible for most people to trade with. So here is the secret behind anyone trade these options and think these are impossible to make money. Even when the stock goes up, I can't make any money on it. Well, here's the secret sauce behind what's going on if you've been wondering why that's the case. In 1996, there were 7,322 domestic companies listed on U.S. stock exchange. So you could pull up your regular brokerage and trade over 7,000 stocks across the exchanges. Well, today we're under 2,223 stocks. Now, you would have thought there's more stocks in 2025 than 1996, right? Actually, there's way less. So too many people fighting over a shrinking supply of stocks because there's a lot more investors in 2025 than there are in 1996, but there's way less stocks. Well, that's causing a major problem, guys, not in the stock market, but actually in the options market. You see why there's now far fewer stocks to trade. What do you think has exploded since 1996? I'm giving it away right there because it's on the chart, but what do you guys think has exploded over the last 20 years? It's not necessarily stock trading, although that's gone up, but what's really exploded is options trading, right? Look at the sheer volume. I mean, this is starting in 2000, but look at just the last 5 years from 2020 to 2025. Crazy, right? So what do you think is happening here? Well, we have less stocks to choose from, and we have way, way more options trading than ever before, which means the options market is consistently overpriced, supply and demand, right? So if you have way less stocks, way more options, and way more people fighting over those options, what do you think the market makers are going to do with those options prices? If you've got a line around the block of millions of people wanting to trade options and the supply of options is going down because there's literally less stocks, what do you think the market makers are going to charge for those stocks with people lining up around the block begging to trade them? They're going to charge a pretty penny for those. And that's why today you often need a stock to move 10+% to make a decent return option, exactly like the example Graham just showed you. So your odds of winning kind of suck when it comes to regular options. And that's why more than 75% of options end up losing money. In fact, that recent report showed 90% of regular options lose money. So with jump trades, we don't need a massive movement in the stock to hit it out of the park with options. We are able to target 100 to 200%, sometimes 300, 350% with a small move in the stock, which unlocks an entirely new realm of possibilities in the stock market because now we actually can go for those outsized returns. For example, take a look at my CrowdStrike trade. This is going back to March, but I absolutely love this trade example. Please pay close attention to this. Okay, so CrowdStrike was selling off in March, right? Had earnings, didn't hit very well, sold back off. Now, most investors are licking their wounds, looking for the next opportunity, but thanks to the opportunity because of options pricing that I'm going to show you here in a moment, I actually loved where CrowdStrike was here on March 11th, and it took me about 95 cents, less than $1 to get into this trade. Now, from here, the stock gained about 2.5%. So everyone see my cursor. Over here, the stock dropped 10% in the course of one day. And over the next 2 weeks, it gained 2.5%. That's a nothing burger. Okay, repeat after me, nothing burger. The stock did a whole lot of nothing. And so if you're trading the overpriced options, the regular options, you are going to lose money on a nothing burger move. At the exact same time that regular options would have lost money, the jump trade hit the jackpot, 163% return on that. How is that even possible? Crazy, right? But we're not done just yet. Next trade was on NVIDIA. At that time, NVIDIA was trading at $34, $3,430 for one options contract. But not only did you have to pay $3,000, you also would have needed NVIDIA to make that big move, which is really the hidden cost of regular options. Both jump trades, totally different story. Instead of paying $34 a contract, we could have gotten in for $1 a contract. Instead of needing 5% to break even, we could have needed 0.5% to double your investment. Guys, think about that. The regular option needed a 5% move to break even. The jump trade needed 0.5%, 1/10 the move to double your money. Are you starting to see the gap in the realities of trading this way? Hopefully, the structure is really starting to settle in with you. If you placed that trade, it would have cashed out with about 150% return over 4 days. If you put $2,500, you're going to make about $3,750 in profit, not total return, but profit in 4 days. Now, $3,700 might be a lot to you. It might be a small chunk of change, but that's no different than a lot of what my students have been doing over the last year, like Modi, who made $11,000, Roger, who made $18,000. But what should really catch your attention with jump trades is that we scored 190% in a couple of days. And to get a return that large, typically what we would need is those out of the money options, right? Those super speculative out of the money options where we need a big return. But for example, on Tesla, we only needed a 1.2% move. On NVIDIA, we only needed 0.5% move on NVIDIA, which is a stock that moves a lot. So you're probably wondering, okay, how is that actually possible? Well, what we're doing is exactly what Graham was talking about, gaming the options market. We're not doing credit spreads. We're not doing risky naked options. The reason most option traders lose is not because they're dumb. It's not because they're bad investors. It's not because they had no clue NVIDIA was going up. It's because Wall Street has rigged those options against you. Just like I was explaining, you've got all these people begging to trade options. Well, what is Wall Street going to do? They're going to ramp up the price of those options. Now, one thing I know is they're not going to share their secrets. They're not going to make it easier for you to make money and for them to lose money. They have one concern, making money for themselves. That's what market makers do. Like Warren Buffett, he publicly preaches about boring old value investing, but really he loves making money using a variation of the same technique I'm talking about today. And then one of the biggest market makers, Citadel, that's Ken Griffin, made over $28 billion last year simply doing. Ken Griffin catapulted to one of the richest men in the world, taking advantage of selling those overpriced options. They do that by selling them to retail investors. So let me ask you guys a question in the chat. Sorry, I'm congested. Let me ask you a question in the chat. When they sell those options to you, what do they want to happen with those options? Do they want you to make money? Do they want those options to turn into 200% gains? Seriously, answer in the chat. When they sell an option to you, what do they actually hope that happens with the option that you're buying? Exactly. Exactly. They want them to expire worthless because if that happens, they keep all the money. So they want to line those suckers up to buy those highly speculative options. Hey, maybe I'll hit it big this week. Maybe NVIDIA will jump this week. Maybe IBIT will go up 15%. But what happens over and over and over again is exactly what every one of you are putting in the chat. The high likelihood is that they expire worthless by the time you're done trading it. But if we just use a variation of what Wall Street does, these jump trades actually allow us not just to, turn the tables back in our favor, but as I like to say, flip the whole table over. That's what we want to do in jump trades. All we need is a relatively small move to start unlocking those triple-digit potential gains. You can even set them to automatically close out like I do if you want. Take a look at what happened. This is my favorite trade example. I love this example. Okay, this is going to blow your mind. If you haven't seen this example before, I use it all the time because I think it's a perfect example of why regular options are broken. Okay, so this was Meta last year, chopping sideways, and I had an opportunity to enter right here, so I did. I actually shared this trade in Telegram. Over the next 3 days, Meta popped nicely, up 3%. Everyone see it there? There's the green circle. Enter on the close. Over the next 3 days, Meta went right up. Beautiful, perfect trade, right? Until you realize the overpriced options were down 16% on that perfect entry. Hopefully that's blowing your mind. You're having a light bulb moment here. Oh my goodness, perfect entry. Stock grinded up 3% in 3 days, and the options lost money. But with jump trades, night and day, you could have gotten in for about 85 cents a contract, and the very same move would have paid out 194%. Okay. If you invested $5,000, you would have lost $800 on regular options, and you would have made $9,700 on a jump trade. Okay. Are you seeing the light bulb moment here? The difference is I'm losing $800 versus having a beautiful trade. A Hail Mary that loses money versus paying for an all-inclusive resort on the exact same trade over the exact same time on the exact same move on the exact same stock. Now, most of the time, the options premiums are so inflated that they look like beta. You have to get that big, big move just to break even on the trade. And that's because of what we just talked about. Wall Street is setting the options prices on the expected move that a stock might make. Typically, it's an overinflated number. Why? You guys already answered the question. They want to keep the premiums. Now, this might be a little in the weeds when I start talking about expected move and implied volatility. You don't have to understand the boring math to take advantage of it, but just so you understand, that's what they're doing. They're pricing it based on an unlikely move so that they keep all the money. But thanks to a little known way to twist those options trades, we're able to shoot for doubles, sometimes even triples when a stock doesn't even come close to that expected move, like Chipotle. Okay, so back in June, this is before the stock even split. Chipotle was trading at $33.65 per share. The market makers had to move all the way up at $34.20. In other words, you would have needed the stock to move $55, guys, not to make a triple-digit return, just to break even on the regular options. So you can see, pretty big gap there, right? You're not just trading a little move, you're trading a huge expected move. But with the special type of options we use for jump trades, you don't need a $55 move. You would have needed about a $15 move, and not to break even, but to actually double my investment, about a 0.4 move on the expected stock, only a fraction of the expected move. Joseph said he's hungry now. Well, you could have traded that for about $2.80 a contract like I did, much better than the $40 a contract call options. Chipotle were some of the most expensive options in the market before the split. And sure enough, the very next day, we hit our target, made 150% ROI. Let me show you an example on Mara. By the way, Mara's on our short list for jump trades. We might take a Mara trade next week. Now, when I took the jump trade back on December 15th, Mara was trading at $18.29 per share. And the market makers had the expected move at $20.66. Now, $2.37 might not sound like a huge move in Mara, but if you run the numbers, what they're actually saying is you need the stock to move up 13% just to break even. Okay, so 13% just to break even on the underlying stock, that's a pretty crazy ask, right? That's you have to absolutely nail the trade of your life just to break even. But with the jump trade, we were trading a much, much smaller move, about 71 cents to get more than a double. In other words, only about a quarter of the expected move. And had you placed that trade with me, we would have generated about 163% in 3 weeks. Now, when I first discovered the jump trades, I was blown away, having a real shot to cash in with doubles, even triples, while most folks are losing money on the exact same move is very appealing. But doing it without needing that big move is really what makes jump trades work. And of course, I've done this on dozens, probably 100 different stocks now. Chipotle, Meta, Coinbase, NVIDIA, MSTR, SMCI, Mara, IBIT, all kinds of stocks that I've done this on, always trading less than the expected move. Now, obviously, you can't go blindly pick any options out there. If that were the case, everyone would be doing this by now. 100, 200%. I mean, no one would be trading regular call options if they know what I know. But you have to know what stocks to target, how to calculate their expected move, and then which options you actually want to twist and take advantage of. And that's why I'm going to show you everything you need to know inside the Jump Trades Masterclass so that anyone can start using this brand new method to target 100%, 200%, 300% on relatively small moves. Now, I've built jump trades from the ground up so the beginners, intermediate, and expert traders can all benefit. I even have a jump trades for beginners in there for you. Now, a few months ago, I held a live step-by-step workshop detailing exactly how to do this with just a couple clicks. Guys, it's not complicated once you have the light bulb moment. It'll show you how to place jump trades in real time. I even show you in my own brokerage account so that you can start using this technique in your account as soon as you go through that class. And like I said, I even have a separate little video series called Jump Trades for Beginners that's in there for you as well. And I'm going to show you in that series the exact technique that we've developed to average a win of 166%. Now, we take losers along the way, of course, as well. But our average win isn't 15% or 20 or 25% like I go for in these defensive trades. It's 166% average win. Now, typically, that class would be worth $497, $997, whatever price you want to put on it. But jump traders get that class totally for free. It's all included if you're a Jump Trade member. And like I said, I even have that Jump Trades for Beginners class in there as well. Now, once you go through that workshop, I think you'll actually be shocked at how simple jump trades actually are. And you'll be able to use them each and every week if you want to. Just a few clicks of a button inside your brokerage account, whether you're using Tasty or Robinhood or E-Trade or Schwab or whatever you use. Few clicks, you get into that trade, you understand how you're targeting, what you're doing, and you can take these same kind of trades. I'll even show you how to set the trade to automatically close out if you don't want to babysit the trade. Just like folks could have seen in February with MSTR. MSTR had an opportunity about $640 a share. That's, again, before the split. You would have needed a 28% move to break even. Are you kidding me? A 28%. I mean, these guys are ripping people off. A 28% move to break even? That's ridiculous. With jump trades, we needed a 0.7% move to more than double our money. So we needed what? What's that? 1/40th the move. And when it all worked out, a nice 122% on MSTR as we closed out automatically. A few days later, on March 4th, my birthday, jump trades, 1.9% move that time around, 150% ROI. Then later, 233% on MSTR. Sometimes when a stock gets hot, I trade it over and over and over again inside the expected move. Just 2.5K into each of those MSTR trades would have been $12,638 in profit. Like I said, guys, I love my defensive trade. I love stacking up income on the more, kind of income style trades. That's what I do most. But there's nothing like jump trades. $2,500 and a 13 grand over a couple of trades. I mean, that's those quantum leaps that you really can't get without a directional strategy like this. Now, those are some big numbers, but we're not talking about hypothetical trades. We're not talking about curve fitted opportunities. Those are real trades that I personally took in my account. Now, any regular brokerage can do this. Even a 401k and IRA can still take these aggressive directional trades. And if you want to see just how powerful these jump trades are, well, then we're going to have our next live class this week, probably Friday, so you can see in action. We're going to do a live jump trades class where we put the trade on in real time so you can see exactly how the trades look on a real brokerage account. I even opened up a couple extra brokerage accounts so that I can show you more opportunities. Now, you can join me for the live class. You can get the master class. You can get the jump trades for beginners, all by subscribing to Jump Trades Alert. So if you're a member, you get it all. Today, I'm hoping you can join me for our next opportunity coming this week. Like I said, Thursday or Friday, we'll do a live class. We'll target another 200% opportunity. And inside this service, which is solely dedicated targeting those big upside moves, thanks to twisting options without needing a large move in the stock. Now, after live trading this for about a year now, here's the cool thing. It's small account friendly, okay? About $100 average position size. We have a really nice win rate, about 60%. Guys, 60% when you're targeting triple-digit wins, it doesn't get a whole lot better than that. You're going to be able to stack up some pretty awesome returns. That's why, like I was saying, whether you use profit factor or Cager or expected result, average result, anything like that, you're going to get the best results on something like this, a 60% win rate that has those really outsized returns. Now, I'll show you how that actually stacks up because some of you are wondering, does a 60% win rate really stack up? Well, I'll show you how it stacks up. But first, if you take one of the memberships today, every single time a trade triggers, I'm going to give you my best jump trade. As a matter of fact, there's one in the members area right now that I just released today. So if you want to jump in, you can jump in today and get that, plus the bonus trade that we're going to do Thursday or Friday, one that I'm personally investing my own money into as well. We typically get 1 to 2 a week, depending on market conditions. Sometimes we'll have weeks where we don't get any. Sometimes we'll have ones where we get 2 or 3 in a given week. Each one based on the same methods, already been able to score 166% on the average winner. And I'll be holding nothing back. Every alert, it's going to break it down for you step by step. When to place the trade, the options criteria, entry and exit. It's all in there. I mean, I do this as straightforwardly as I possibly can for you. And I'll even give you the profit target so that you can set these up to close automatically like I do, which is one thing I love about jump trades. You can set this, forget about it. The market gaps up, boom, holy crap, I just made 200%. I wasn't even paying attention. That's always fun with the jump trades. Now, each alert, like I said, is going to have clear instructions, okay? I do all the heavy lifting because I'm trading these with my own money, and then I ship it off to you in a straightforward alert. Just like AGQ, you would have got the alert, could have clicked a few buttons, got in. Maybe you would have been at a wedding with friends across the world like I was. I was in Germany that week. Or maybe explored the trails of beautiful Breckenridge, Colorado, which I highly recommend. Or maybe went and jumped into the lake. See what I did there? Jumped into the lake. That's a pun for all of you guys in the chat there today. Jumped into the lake during your jump trade. No matter what you were doing, 120% automatically locked in. You wouldn't have had to watch the charts. And don't feel like you need to be sitting next to your computer all day long. I want your experience with these jump trades to be as hands-free as possible. Of course, alongside the email alerts, also include cell phone, Telegram alerts. Jump Trades has a specific Telegram, private Telegram for Jump Trades members only. So you get the entire alert inside Telegram when you join. And I'll be keeping track of the jump trades for you so you can easily see how your results look compared to the S&P 500. It's all live in the tracker, just like the next one on CCJ that we put out. Text, Telegram, anyone taking that one would have hit an automatic 200% target on CCJ. Just those last two alone, 2,000 would have flipped into 5,400 bucks. Those are the kind of returns we're talking about in jump trades. Not 15, not 20%. This is my most aggressive strategy. So with that kind of potential, the biggest potential I have in any strategy, obviously jump trades could run at a pretty steep price. Our top alert services like this go for $4,500, $5,500 per year. So I think that price will be more than fair. But luckily for you in here, of course, it's not going to be $5,000. You guys know I wouldn't do that to you. Not going to be $5,000 a year. I've set up an amazing deal. If you guys want to get in on the very next jump trade, including the one that's in the Telegram and the members area right now, and the next live class, you can jump in today for a much, much better price. But before we talk price, let me highlight one of the biggest benefits of being a member of Jump Trade Alerts. And I really think it does take this to a whole new level. I hinted at it earlier, but what makes jump trades really unique is that they only activate after a very specific set of signals that occur in a specific set of stocks, okay? It's all about that expected move. Typically, that means a bullish move in the stock, right? You guys know I usually take bullish trades. Probably not a surprise to most of you in here by now. But with the current concerns blowing up, inflation being sticky, national debt, obviously the trade war stuff, the actual conflicts, President Trump shakeup, all that kind of stuff. Hopefully you guys are not disillusioned that we're going to get some volatility over the next couple of years. Well, for most investors, that's all concerning. That's terrible news. But for jump traders, it's actually a hidden gold mine because we can reverse engineer the same method and actually trade negative momentum, not just positive momentum. So it doesn't matter if we're in a bull market or a bear market. It doesn't matter if we're caught in the middle, as long as we find stocks that have that volatility. So as a bonus, you will get all of the downside jumps as well. So whenever we pick up a stock with more downside potential, that negative momentum, I will also package that up and send you that as well. Like my very best trade so far ever in the history of my accounts was on SMCI, and it was actually a bearish trade. So if you took that trade with me, that was in February, you could have gotten in for 25 cents a contract. And the very next day, guys, this is a one-day trade from one day to the next day, Thursday to a Friday, you would have hit not 200%, not 300%, but a absolute jaw-dropping 1,500% ROI. Now, just don't get me wrong. That's not our average trade, guys. We're not expecting to hit 1,500% on average, but that's the power when the market's flushing and you have negative momentum. SMCI, if you put $1,000 into it, it would have paid out 15 grand in one day. Now, if you put $2,000 or $3,000 into it, yeah, you would have had the trade of a lifetime for sure. But like all of the trade examples, it was a real trade I took with real money on a real opportunity with jump trades. Now, I'm hoping we get 100 new people for our next class. It's always my goal. Anytime, just so you guys know, anytime I do a jump trades or I do a new live class, my goal is to get 100 new people in for that next class so that I can go through the training, I can train people up, I can onboard a new set of students. So my goal is 100 new folks by the time this opening playbook session is over. Now, like I said, we could charge $4,500, $5,500, $7,500, whatever, especially if you consider the fact that the live trades over the last year, if you started out with $1,000 and took every jump trades, you would end up with about $41,000 in profit. Guys, that's 1,000 to 41,000. Pretty good. If you started with 5K, you would end up with $205,000 in profit. Pretty ridiculously good. So if you guys are wondering, hey, does that 60% win rate really stack up profits? Well, when your average winner is 166%, yeah, it really stacks up profits. $5,000 is $205,000 over that set of trades, winners and losers included, not compounding, no back testing, just real-time trade alerts that I took with my account in real time. Given the real money results, I think $5,000 a year would be more than justifiable. But if you're one of the folks in here today, I've got a couple of surprises up my sleeve. Let's get into it right now to get you guys in the door before the end of the day. So the first thing, your first 25 trades on me. So the average jump trade is about $1 per contract, which means about $100 to enter the trade. Some less, some more, but that's about the average. So just to have some fun, I put your first 25 trades on me to get you into it today. So on the house, what does that mean? That means basically $2,500 is going to immediately come off of the price today when you join. So 100 trades on me times 25, $2,500. That takes it from 5K down to 2,500. But just to get a little more fun, the average result so far is about a 60% net return. Okay, so 1,570 invested, that's $957 in profit. Now, obviously, I can't guarantee today's trade that I just posted is going to be a profitability or end up in a profit. How did I say that? I can't guarantee today's trade is going to end up as a profitable trade. That's what I'm trying to say. I'm not a genie. I can't guarantee it. But what I can do is pay it forward with the price. So instead of waiting to see if it's a profit, I'm just going to pay it forward right now with an additional $957 credit off the membership. That way it feels like you already got your first winner under your belt. So when you join today, you won't even pay the $2,500 price. You can join with the additional $957 off, just $1,543. And yes, that's for an entire year, 50, 60, 70 trade alerts, all averaging an average of 166% on the winners and a net over 60% return. Pretty darn good. Now, considering that 1K turned into 41K or 5K into $205,000 in net profit on the trade, I think 1543 is a pretty darn good deal. And hopefully we're going to get our first 100 here by the time this opening playbook session is go. And I'm really excited because not only are we going to have our next live trade, which, as I mentioned earlier, I think the momentum starting to pick up here is going to be pretty exciting for these. We also have a current trade. So you're going to kind of get two for the price of one, if you will, when you join, targeting 200% this very week from a small move in the stock. And I also have a special surprise because we put back on a price that we haven't done in a long time with the 2-year membership. So if you join right now, you click the link that I'm about to drop, you'll see the 2-year membership for the price of $300. So you can buy your second year of access for $300. Not going to get a whole lot better than that. So you can get the 2-year for just $1,843. That makes it about $900 a year for the highest profit factor, highest cager return that I have on jump trades. Again, that 2-year deal is available, but it expires at midnight today. When we do those 2-year deals, we try to make them just for the action takers, and then we pull them back off. So you're here right now. You want to take advantage of the current alert that's in there, plus our next class, plus the next 1 to 2 trades per week, plus the exclusive downside jumps. Then go ahead and act now. Claim your 2,500 credit plus the 957 and join today. You can do that by clicking the link in the chat that we're posting right now. That's going to be in there, just in the Zoom chat. You can click it directly. And of course, you can jump in with the deal expiring at midnight at prosperitypub.com/jump. Okay, that link is not posted yet. Sorry. Dakota, can you post that link in there so they can click it right from the chat? Let me post it for you. That didn't actually make it clickable, though. Hold on. There we go. That should work. That link should pull up the special deal for you. There we go. Now we're cooking. It looks just like this. You can get the 1543, which is already, the pretty ridiculous savings if you ask me. One trade, $1,000, and our average winner would return $1,600. So I think 1543 is pretty darn good. But the second deal is only $300 for the second year. Now that deal does expire today. So if you want to get the 2-year, you have to get it right away. But that makes it about $900 a year for access if you want to get the Jump Trades special discount. Okay. So either one, I think highly recommend both, but obviously if you want to get the 2-year deal and save as much cash as possible, you can do that right now. Oh, let me take a drink. I've been talking too long. Now, of course, you guys know the drill by now. Whether you take the 1-year or the 2-year deal, don't close the next page. All right. Hopefully you guys know the drill by now. We have the lifetime option on the next page. Now, the cool thing with the lifetime option of Jump Trades is that you're not only going to get no renewal fees ever again, you're only just going to get the best savings, but that's only half the perk because you will also get the expected move indicator for Jump Trades if you're a lifetime member. So that's only for lifetime members. If you take lifetime, click the next page. Yes, on that second page, you will get that opportunity. I'll give you free access. Again, that's for the lifetime members only. Instead of charging it as a separate indicator, anyone can get it for free by becoming a lifetime member of Jump Trades. Again, that's prosperitypub.com/jump. So I'm just looking through the chat. Okay. Let me jump through a couple of the questions here real quick that we get, and then I will jump into the chat for you as well. Okay, let me find my questions. Okay, how much money is needed? Well, the trades are pretty cheap, actually. 50 to a couple $100 on average for the Jump Trade. The most recent one I put in was $22 a contract. So pretty darn cheap for Jump Trades. Will every trade be a winner? No, this is actually one of my lower win rate strategies, guys. Why? Because I'm going for those big winners. So I'm going for those bigger winners. Obviously, I'm going to have a low. We're not trying to win 90% of the time here. We're trying to win 60% of the time. If we can win even 55 to 60%, we're going to have a big profit factor and a massive positive expectancy. So no, not every trade is going to be a winner. Should be worried about more downside. Well, the beauty is I'm not looking for a overall trend. I'm looking for a relatively small move at a particular time. And of course, we can trade to the downside as well. That's part of the advantage of Jump Trades. If we have negative momentum, we can trade it to the downside. Can you trade an IRA or 401k? Yes. Risk defined. As long as you're approved for options, you'd probably need level 2 or level 3 options. You can absolutely do it in a retirement account. You just have to get approved. Is there any kind of guarantee? Yeah, of course. If you don't like it, go through the masterclass, join me for the live trade, see it all works. You don't like it, no problem. You can get a refund. Okay. We also have customer support live. If you do have any questions, how do the trades work? Am I doing it right? You can join them live, 10 a.m. to 1 p.m. Eastern every day to get all of your questions answered. Okay. So take advantage of that. What's this week's Jump Trade? Well, of course, I'm going to be sharing that with the members. And if you click the link and go to the masterclass, I also have a Jump Trades for beginners that you can check out. Okay. So prosperitypub.com/jump. You can call the team as well. Take advantage of that 2-year deal because that's the one that expires. Someone asked, what indicator am I giving away? It is a custom indicator that looks at that expected move so you can see relative to where we're trading, where is the expected move on the stock, and you can try to get in less than the expected move for an outsized return, because usually you're kind of screwed when you trade an option. You're trading against that expected move, and then as the stock moves around, you have to get in and way outperform that expected move, which I think is basically impossible to do on a consistent basis. But what we do with Jump Trades is we actually trade less than the expected move and still go for that outsized return. Hopefully that makes sense. That's what that indicator does. That's for lifetime members. Kim, Jump Trades, we're going for a momentum trade that is normally 150, 200, or 250% ROI. Okay, let me type that in. There we go. Bob, thank you for joining. I saw a couple other people. I didn't get to shout out everyone. Let me know in the chat if you jumped in. I'll give you a shout out just so I know who's all jumping in. I'm sure we will get to our cap here, pretty quickly, hopefully before our next live trade. But just a reminder, that 2-year deal is the one that's going to expire very quickly here. So I'd love for you guys to jump in before that 2-year deal expires if you want to get the best deal on jump trades. Oops, let me edit that. I gotta make that clickable. There you go. You can click that now. All right, that link is in there, prosperitypub.com/jump. When you click it, it's going to bring up both the 1-year and the 2-year. Either one you choose, guys, you will have the VIP option. And Bob, yes, there actually is a trade that I posted about an hour ago that's still valid in there if you want to get in. So you'll get in you'll get in today's trade plus the end of the week trade, both if you want to take advantage of that. All right. Thanks, Jimmy. Thanks for being here. Hope you have a great afternoon. Yeah, Craig said some brokers are requiring more funds to trade spreads these days. That's true. I have seen some students have success by telling them, hey, in order to keep my account with you, I need to be able to trade a certain level. Some people have had success with that. Other people, I recommend, honestly, move to a broker that's going to do what you want. That's my personal opinion. If you want, to trade without having issues all the time, make sure you're in a broker who's going to let you trade exactly how you want. Mark, yes, the risk is whatever you pay for the spread. Exactly right. So if I put on a spread like I did yesterday for 22 cents a contract, in other words, I'm paying $22, and I put on 10 contracts for $220, I'm risking $220 in that case to make about $800. Actually, about $780. That would be $220 to make $780, and that would be your risk. Let me just flip through here. Dave, that's honestly a good question. It really depends on your risk profile and how you want to approach the market. So, Dave, I'm a diversification via strategy guy. I like trading lots of strategies at the same time. Not everyone's like me. Not everyone wants to have an aggressive strategy, a kind of middle of the road strategy, an income strategy with longer term, an income strategy with shorter term. I like to diversify by using strategies. So I don't really believe in diversification through assets. I don't think just holding different assets is a good way to diversify. In 2022, that didn't work. In 2008, that didn't work. In 2000, it didn't work. So I don't like doing that. I like trading by using multiple strategies as my approach to diversification. But that's not true for everyone. Sometimes people have too many things that they don't even they can't even keep track of. Obviously, that's not a good thing. If you're trading too many things to keep track of, that's not a good thing. So I wouldn't recommend that. I like using systematic strategies so that I can trade, 10 different things, but they're all systematic. They're all manageable. Someone asked about using Robinhood as a broker. I do have a tiny $1,000 Robinhood account just so I can use that as an example, but I've always had trouble getting good fills with Robinhood. Now, Robinhood does have no commissions, I believe, for most people, so that will balance out the fill price being a little bit higher. You have to, kind of make that balance. But I've always had a little bit of trouble on the fills being as good as other brokerages. Shrita, yes, most brokers should let you trade any kind of risk-defined debit spread with level 2. Some brokers have now flipped it. They have 4 levels, 5 levels, and so you have to be at level 3 or whatever. but most brokers, it should be level 2 risk-defined spreads. Joe said he's been getting good fills with Robinhood. That's good. David, yes. So the track record right here. So this is based on the 1K turning into 41K. We're at about a 58.8% win rate. Average win 166%. Average net return about 60%. So for every $1,000, we're net averaging $600. Winners and losers combed in there. Obviously, it's not going to be a 90% win rate kind of strategy. This is going to be an outsized return and then blending in net positive return. So that net average return is going to be about as big of a return as I'm going to have on any of my strategies simply because of the mechanics of the strategy. Yeah, I agree, Joe. I mean, the Robinhood app is definitely the easiest to trade on, the most intuitive. I just had some troubles on the fills. Shrita said tasty trade with level 2 with no issues. That's good. I also opened up a tasty trade account, a little $2,000 account, so I can give examples in there as well. So that when students ask me, hey, how does this look on Tasty Trade? How does this look on Robinhood? I at least have something to pull up and show you guys, and not just my Schwab account. By the way, thanks, Kurt, Joe, John, Katie, Glenn, Allen, all the folks who jumped in. I know I didn't get to call out everyone. I saw a couple of names in there. Thank you for joining. Excited to have you. There is a trade right now that you can take a look at that's active and should be right in the same price range as when I alerted it. And then we also will have a live trade class this week. John, you should see an access link from One Click Trading. That's where it should come from. And then inside One Click Trading, you should have an opportunity. Bob, the only one that I would look at is the one that I posted this morning in terms of pricing. So I would look at the one from this morning. And then obviously we have our trade that's going to be coming this week. Rob and some others that jumped in. Thank you. Looking forward to it. This really is very different for me, guys. If you guys follow me, I know many of you in here are overnight options members, your income machine members. That's my bread and butter. Those high win rate income structures where I'm just trying to churn as much income. This is my directional strategy. This is what I do when I'm going for those bigger wins. I do think we're going to get some momentum picking up in the market. As a matter of fact, I think we're going to get momentum to the upside. And then I think we're going to get momentum to the downside. And I want to trade in both directions. And so this is what I do when I want to go for those bigger outsized returns. So it's blended in. Now, interestingly, even though most of what I do is more, conservative defensive strategies, because the average win is so big, this is actually the most aggressive compounding strategy. So if you look at all my strategies and you said, hey, if I put $2,500 into every trade, which one would have the highest net ROI? It's actually this one. So it's not my bread and butter strategies because this simply has the biggest upside potential. Now, does that mean that I would recommend this strategy above the others? No. It's a give and take. It depends on what you're looking at, how you want to blend your strategies together, all that sort of stuff. But it is interesting to note that even though it's not my typical approach, it does have the highest net potential simply because those winners are so big. So even though it has the lowest win rate, it has the highest net performance. Sal?
All right, folks, that is the presentation on jump trade alerts. I've opened up the regular chat in case anybody was having trouble direct messaging me. If you have any questions, last chance to get them in here, and I'll try and answer them for you on screen. Again, this was a deal that we did the other day, and it went so fast that basically nobody in opening a closing playbook even had a chance to do it because he ran at midday and it filled up right away. So we opened it up again today for those of you who attend those sessions. Well, really just closing playbook. But if you want to get in, this price will be gone by midnight tonight. So you've got a short window here to take advantage of the pricing. Of course, you can always get in the program. It just costs a little bit more later. And if you have any questions, trying to decide, go ahead, put them in here. Let's see. A question here, both put debit spreads and call debit spreads. So I think that he is doing only debit spreads, and he does go in both directions with this, so it should be both calls and puts. Let me take a look at the actual trade tracker and just make sure I'm answering you correctly. Hold on one second. Um, where'd it go? Yeah. Yep. So we've got mostly upside, mostly calls to the upside, occasionally puts to the downside. There are always going to be debit spreads, which means, whatever you pay to get in the trade, that's your maximum risk. The worst that can happen is it goes to zero. You don't have to worry about, like some infinite risk or coming up with money to close out the deal or anything like that. So put debit spreads and call debit spreads. That's correct. Any other questions? 2-year and lifetime cost. So the 2 years, what you see on the screen, you're getting 2 years for 1543, I believe is the case. Let me double check that. That might be the 1 year. Yeah, the one. Okay, so 1 year for 1543, 2 year for 1843, and then the VIP lifetime is an additional 2 grand on the 1 year. So it's about 3,500 and change all in on the lifetime. So 1543 for a year, 1843 for 2 years. That's an either or. You're getting the second year for 300 if you do it right away. And then you can upgrade to lifetime for another, depending upon which of those, options you took, another 2 grand or less if you took the 2 years. So it's about $3,500, just a little over $3,500 all in on the lifetime. Do, 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 do. So with this, you're going to get roughly 1 trade a week. Sometimes he might have to skip a week. Sometimes you might get a couple of trades that week. And these are going to be going for those big wins. So as he talked about, the win rate will be a little bit lower. The overall profit will be higher because the wins are so big that it more than compensates for the lower win rate. It's still an over 50% win rate, but compared to other strategies he has that are in the 80 percentile and 90%, then this is going to feel low if it's 57%, if it's just above 50-50. But even if it was just 50-50, you'd still come out ahead because you're talking about like 200-300% profit on some of these trades. And I think, almost all of them are over 100% profit, which means if it was 50-50 and they were exactly 100% profit, you'd break even except for your brokerage fees. Being that it's over 50% and over 100% win rate, you're coming out way ahead. Average holding time, I believe, is like 10 days. Let me double check. Yeah, about 10 days. About 10-day average hold. Let me give you the full. Yeah, so the average return with your winners and losers combined or whatever is over 50%, which means that if you just average across every trade, looking back, the average was over 50% gain on every single trade. Of course, the winners average over 150%, and the losers average under 100%, but pretty close. So, you know, you're losing a little under 100%, you're making over 150%, and you're winning a little more than half the time. You come out with about a 50% return on every trade. Average over 10 days, so that's about 5% a day. And those are calendar days. So you're even making that 5% on the weekends. Any other questions? So keep in mind that if we trade this weekly, um, you and maybe occasionally like twice in a week or something like that, and you're holding them for 10 days, there is overlap. You could be still in the previous trade, one or two trades when the next trade comes out. So depending upon how much you want to allocate in your account toward trading this program, you may want to leave some room for overlap so that you're not all in on tomorrow's trade, and then next Tuesday you can't take a trade because you've used your full allocation that you gave yourself on jump trades on the one trade. Now you certainly can. I mean, there's no reason not to, but by diversifying over more trades, you'll increase, your performance a little bit. And you'll have a little bit more, I think, enjoyment, assuming you're doing this because you want to be and you want to be placing trades. The more often you can get in them and so on, the better. But yeah, it's really up to you. Like, we're not going to tell you how to manage your money. I just want to point out that there can be some overlap in this versus one of Nathan's programs, like, let's say, overnight trades, overnight options, where like you're pretty much getting out within the same hour you're getting in the next day. And something like weekend options where you're out way before you get into the next trade. This will have some overlap, which doesn't make it better or worse. It just means you might need to allocate your funds to less than 100% of what you want to put into jump trades onto every trade. Any other questions? All right, well, I suggest you write down the phone number that's on the screen, and I'll read it out: 904-706-3537, just in case you come up with a question after we close out the webinar. Then you'll have some place to go to ask. What else can I tell you? I mean, Nathan's been trading this since, he actually technically started at the end of 2023, but really full-fledged January 2024. So we're coming up on 2 years that he's been trading this program, and that average return of 50% on every single trade is over all 2 years worth of trades. So it's not a small data set that we're averaging those returns on, and it's including every loser. So pretty good stuff. But you just have to be able to kind of stomach the win rate, which is just slightly above 50-50, knowing that your wins are going to likely outweigh your losses significantly. At least historically they have. We obviously can't promise what it's going to happen in the future, but over the last 2 years, it's made $330,000 in the sample account, and it's lost 146. So you're ahead $185,000 in 2 years, trading $5,000 every trade. 5,000 a trade turned into 185,000 in say 22 months. Yeah, 22 months. 5K turned into 185K in 22 months. That's crazy. All right. Is it set it and forget it trades? Do you have to close the trades or just let it expire? So the vast majority of them, you can just let them expire. What you do need to do is just kind of keep track of the expiration dates on the trades. And so you can play these one of two ways. You can set a target, and he uses targets on these a lot. You can set a target and get out based on that, which means you'll likely have a little higher win rate and slightly lower wins per trade, which might net you out ahead overall. Or you can just let them run to expiration, and you're shooting for max return, but then your odds of success are a little bit lower because it has to be where you want it to be at expiration and not just at any point prior to expiration. Just like any of the other debit spreads that we do. So you have that. The only time you really have to make a decision one way or the other is on expiration day. If it looks like it might expire between the two strikes of the spread, you don't want that because you don't want to get assigned the stock. So if say 3 p.m. on day of expiration, it's still kind of hovering between the two strikes, you would close it out. You put an order in to close it out. If you didn't already have like a profit target set and hit that prior, and you were still like between the strikes at the end of the day on expiration day, you would want to get out of it before it expires at 4 o'clock. So other than that situation, which happens from time to time, but not that often, then it's really just up to you how you want to play the strategy. Set a profit target for like 80 to 90% of your max potential return, and maybe get out early, get in another trade sooner, that kind of thing, because you have your money back and you have a higher chance of winning, but you're not winning quite as much. or just let it run to expiration to shoot for max possible returns. And Nathan goes over all that in the training. If you join this program, please take the training. You don't have to become an expert on it before you start trading it, but you should understand the basics and what your risk is when you get into each trade, what you are waiting, what you're looking for the stock to do in order to win, and that kind of thing, and how to take the trade and put it in your brokerage account and execute the actual trade itself. And like I said, when you need to worry about watching it and placing an exit order. But 9 out of 10, you wouldn't have to close if you didn't want to set that profit target for early exit. 9 out of 10, you just let them run to expiration if that's how you prefer to trade it. All right. Last chance. Any other questions? If not, we're going to go ahead and close out the webinar. We will be back tomorrow morning at 10 a.m. Eastern time for opening playbook. I'm not sure if we're having a guest on tomorrow morning. I know we're having a guest on Friday morning. I think Graham's doing a class tomorrow. I think Graham's going to be doing our opening playbook class tomorrow, and then we have a guest for Friday morning, but I'm not 100% sure. All right. We'll see you tomorrow. Have a good night. Good luck in your trading, and hope to see you in opening playbook.